So this week we got an updated reserve balances from the Fed on Thursday evening. It showed that reserves fell to $3.2 trillion. That was a decline from about $3.3 trillion the week before. And again, we talked about this a couple weeks ago. It has to do with the fact that you've seen the reverse repo facility basically become net neutral to reserves, and we've seen the TGA continue to rise. And so if we go back to the reserve balances, we have largely expected reserves now at this point to start getting drained because we've seen the offsets that the reverse repo facility was offering basically now extinguished. And so what this really means is that from this point forward, we're going to see a continued drain on reserve balances. And based off of where the reserves are right now and based off of where the TGA is expected to go, which the Treasury indicated it wants to get it to $850 billion by quarter end, we would expect that, we would get reserve balances to come down by another 200 to 250 billion. Right now we're at 600 billion on the TGA, so that means 250 billion more. Right now reserves are around 3.2 trillion. Less 250 billion would put us somewhere around 2.95 trillion, give or take. And then, of course, the Fed will just, continue with quantitative tightening, which has been going on in the background now for some time. At some point, the Fed will be forced to stop quantitative tightening, but right now we're not there yet. And it would seem to me that we're likely to see the reserve balances go below 3 trillion. And now next week we're going to be seeing, Treasury settlements really ramp up. In fact, starting on today, August 29th, we're getting a Treasury settlement, 36 billion. Then on the 2nd, we're getting a Treasury settlement for coupons of 90 billion and for bills of 50 billion. And then on the 4th, which is Thursday, we'll be getting another settlement for bills of 20 billion. So that means that over the next 4 or 5 trading days, there's about $200 billion in settlements that are going to be coming. And that's going to potentially, push reserve balances even higher. Now, the difference, obviously, at this point is that the reverse repo facility is no longer going to be a funding source for this. In fact, when you kind of go back and you look over a period of time, reverse repo facility, was around, at one point, the reverse repo facility was around 2 to 2.5 trillion. That's all basically been drained at this point. And now that it's at basically zero, there's no more cash in that facility to offer any offset as the TGA is beginning to get refilled. And so that could have a lot of different impacts, some of which we're not really going to know right away. But there is certainly some correlations and some things that suggest we could see some tightness in markets. This is, I have in the title FINRA margin, but basically this is, we're looking at primary dealer repo, equity repo positioning. And, you can see there's this loose relationship between changes in reserves and changes in reserve balances. And when, equity repo financing is increasing, basically that's a net positive for the equity market because that's a source of liquidity. You'll be able to see the relationship between the two over time. I mean, again, this isn't something that has been widely followed for a long time. You can see certainly starting in 2022 as equity financing, through repo came down, you can see the market came down. And then as this bottomed out and the market began to rally again, you saw this really begin to increase again, which is a whole nother story. But one would think that if reserve balances are getting depleted and dealer balance sheets start feeling some of the constraint, you could see repo activity begin to decline. The other factor is obviously, it's margin balances. We have margin versus the reserve balances, and over time, these two have certainly been highly correlated. But when you start going back over the years, you really start seeing how strong this correlation is. And in fact, when you start going back all the way to about 2009, you can see how this relationship has evolved and how when, margin balances are fairly steady during periods of stable reserve balances, you can see that they even increased a little bit during this period of time. But when reserves really started coming down hard in 2017, 18, and 19, you saw margin balances come down hard. And when reserves increased, margins increased, they came down again. And so again, we're in this position now where Perhaps after a period of stability in reserves, we saw margin balances expand, and if we start seeing this coming back down again, you could start seeing margin balances decline. And of course, we know that the equity market, we know that basically as margin balances are rising, the equity market tends to rise. I mean, it makes a lot of sense. So there's these, indirect relationships between all three. And this is really the reason why we just need to continue to pay attention to these things. And, as we go through the next couple of weeks and reserves continue to decline, it's likely we start seeing some of those reverberating effects start to take impacts really going between now and the end of September. And we'll just have to keep up on it and see how things sort of develop over the next couple of weeks. Anyway, please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you again soon. Bye.